So in this video, I will be recording the pecking order hypothesis and the signaling theory. So first we will discuss the pecking order hypothesis. The presence of flotation costs and asymmetric information may cause a firm to raise capital according to a pecking order. In this situation, a firm raises capital internally by reinvesting its net income and selling off its short-term marketable securities. Then, they have exhausted this means, so when the supply of funds has been exhausted, the firm will issue debt and perhaps preferred stock. Only as a last resort will the firm issue common stock. So we know that the internally generated capital is the most convenient one. So first the business will try to use that means. Once that is finished off, then they will go to the external market. So then they might go for debt or they might go for preferred stock. And once the option of debt and preferred stock is also finished, then only they will go and issue common stock, because issuing common stock is the most expensive option due to flotation costs. This is the pecking order hypothesis. So usually businesses are expected to follow this kind of an order when raising capital. The next theory, signaling theory. Assumed that everyone, investors and managers alike, has the same information about a firm's prospect. This is called symmetric information. So if everyone has the same information, which means if you're an employee in a business, you have the same information as the CEO, and a customer also has the same information, then that is called symmetric information. And in the theory, it was assumed that everyone had symmetric information, so everybody knew everything. However, managers often have better information than outside investors. This is called asymmetric information. Of course, you're the managers of the business, the CEO, the CFO, and even the middle managers will have more information than an outside investor, because they do not know what is happening in the company. They will know only enough as much as the corporation tells in the press release. And sometimes companies do not tell everything in the press release because of competition as well. Um, Now, the signaling theory says that we would expect a firm with very favorable prospects to avoid selling stock and instead raise any required new capital by using new debt, even if this moved its debt ratio beyond the target level. And a firm with unfavorable prospects would want to finance with stock, which would mean bringing in new investors to share the losses. So the theory is telling us that in order to understand this theory, let's take an example. A business a business is about to set up a new project, and they know already that the project is quite feasible and it will be very profitable. Now think from the manager's perspective. The managers are always trying to maximize shareholder wealth. So they will want that the profit is shared with the existing shareholders and not with the new shareholders. अब जैसे किसी का बिजनेस है तो उनकी कोशिश क्या होगी, जो उनके अभी करंट ओनर्स हैं ऑर्गेनाइजेशन के, उन्हें ज़्यादा से ज़्यादा प्रॉफिट मिले. सो दे वुड वांट कि वो जो नया प्रोजेक्ट है उसके लिए वो न्यू शेयर होल्डर्स लेकर आए. इंस्टेड ऑफ दैट दे वुड प्रेफर कि वो डेट होल्डर्स ले आए, बिकॉज डेट होल्डर्स को तो एक फिक्स्ड इंटरेस्ट पेमेंट मिलेगी एंड वट एवर इज़ द रिमेनिंग प्रॉफिट विल गो टू द एग्जिस्टिंग शेयर होल्डर्स. इसी तरीके से इफ़ द बिजनेस इज़ इन अ बैड सिचुएशन और दे नो दैट फ्यूचर में कोई लॉस होने वाला है, सो योर डेट होल्डर्स आर नॉट गोइंग टू बेयर द लॉस, ओनली दी स्टॉक होल्डर्स आर गोइंग टू बेयर द लॉस. सो उनकी कोशिश होगी वो और शेयर होल्डर्स को ले आए, so that the losses are divided amongst more people. Let's say पहले 100 shareholders हैं और अब पता है मैनेजमेंट को कि फ्यूचर में कुछ मिसहैप होने वाला है, कोई स्ट्राइक होने वाली है, एनीथिंग जिसकी वजह से बिजनेस को काफ़ी लॉस होने वाला है. Now at this point, if they issue new shares in the market, let's say if they bring in 100 more new shareholders, तो 200 shareholders में वो loss divide हो जाएगा, whereas पहले सिर्फ 100 शेयरहोल्डर्स में डिवाइडेड था. This was the second point. So, the conclusion of the signaling theory is that the announcement of a stock offering is generally taken as a signal that the firm prospects, as seen by its management, are not bright. So, usually जब stock offering की बात की जाती है उस वक्त stock price थोड़ी सी आपकी decline हो जाती है. स्टॉक प्राइस आपकी इस वजह से डिक्लाइन होती है बिकॉज एवरीबडी इन द मार्केट इज़ थिंकिंग के इफ़ दे आर इशूइंग न्यू स्टॉक दैन समथिंग बैड इज़ मोस्ट लाइकली अबाउट टू हैपन बिकॉज दैट इज़ व्हाट द थ्योरी इज सजेस्टिंग. Whereas if the company does not issue new shares and they go for loan, then everybody has the perception, okay, so they are not going for shares, they are instead going for loans. और loan तभी corporation लेती है जब they are very sure about the earnings of the business. So most probably कोई अच्छी खबर है जिसकी वजह से they are willing to take on more extra loan. ठीक है? So this is the signaling theory, and with this our topic concludes.